Have you ever made an investment decision that cost you dearly? You're not alone. Many investors, even the seasoned ones, make the same costly mistake, often due to a lack of understanding of their own circle of competence. But what if I told you that avoiding these mistakes could be simpler than you think? In this video, we're going to dive into the concept of the circle of competence, a powerful tool that could help you make smarter investment decisions and avoid the common pitfalls that drain your wealth. Imagine being able to confidently assess any opportunity, knowing exactly where your strengths lie. This isn't just theory, it's the secret behind some of the most successful investors, including Warren Buffett. By narrowing your focus and sticking to what you know best, you can significantly reduce the risks of making decisions that lead to financial losses. Ready to learn how? In the next few minutes, we'll uncover the circle of competence and how it can transform your investment strategy. You'll discover how understanding your expertise can give you an edge in the market and help you avoid those costly mistakes that plague so many investors. Stay with us, and let's turn those potential errors into opportunities for growth. Have you ever wondered why some investors always seem to get it right at the right time? One reason is that they understand long-term economic fundamentals, which is crucial for any investor. By focusing on aspects such as economic growth, consumer behavior shifts, and market trends, these investors gain a clear view of what lies ahead. With this understanding, they can make more confident and well-founded investment decisions. Investing without this perspective is like walking blindly through a financial maze. Economic predictability is one of the key pillars of this understanding. Great investors like Warren Buffett emphasize the importance of studying the sector you're investing in, observing its cycles and how it behaves in the long run. The idea here isn't to look for quick wins or follow fleeting trends, but to seek businesses or sectors with sustainable growth potential. This involves understanding the financial risks involved and how they might impact your investment decisions over time. Understanding long-term economic fundamentals helps avoid errors of omission, which are often more damaging than errors of action. Those who grasp the market and its cycles know when to enter and exit. Warren Buffett often says that one of the biggest mistakes he made was not investing in opportunities outside his circle of competence. The invisible impact of these mistakes doesn't show up immediately, but it can be devastating in the long run. Understanding the fundamentals of long-term economic trends can significantly impact your investment decisions. Take, for instance, the example of Wrigley's gum, which has consistently been a staple in the market for decades. The demand for gum, especially the type that Wrigley offers, has remained relatively steady, even through economic downturns. This kind of predictability is a key factor in successful investments. When you can identify such consistency in a market, you're already ahead of the game in terms of timing and decision-making. Investing in products or companies with predictable demand offers a sense of security. You might not expect massive growth like in high-risk tech stocks, but you can trust that the demand for these products will remain strong. Wrigley is a prime example because it aligns with the simple principle people chew gum because they enjoy it, and that need won't disappear overnight. The trick, however, is recognizing such opportunities and understanding the dynamics of the market to avoid making costly mistakes. This type of market predictability is what makes certain companies valuable in the long run. Just as Wrigley's gum has been a safe bet for investors, there are other markets that exhibit the same stability. Identifying these markets and understanding their economic cycles can provide a reliable way to build wealth. It's about knowing where to place your focus and when to pull back to avoid unnecessary risks and losses. One of the key principles in successful investing is the necessity of understanding the dynamics of the sector you're investing in. This goes beyond just reading up on a company. It's about comprehending the broader market trends, the competition, and how each player contributes to the overall industry landscape. For example, when investing in technology, it's crucial to know who the market leaders are, what their innovations look like, and how they stack up against emerging competitors. By studying the competition, you can make more informed decisions. It's not enough to just trust in a company because it seems promising. you need to evaluate its competitive position within the market. Are they ahead of the curve, or are they just another player trying to catch up? Understanding the competitive landscape allows you to assess whether an investment is truly worth it, or if you are better off putting your money elsewhere. Additionally, understanding market dynamics also involves knowing how external factors such as regulatory changes, consumer behavior shifts, and technological advancements will impact a company's performance. For instance, a government policy that favors electric vehicles could drastically improve the prospects of companies within the green energy sector. Therefore, keeping an eye on industry trends and potential disruptors is as important as assessing individual companies' financials. When we think about investment mistakes, we often focus on the ones we make: the bad buys, the risky decisions, the markets we entered at the wrong time. But what if I told you the biggest mistakes are often the ones we don't make? These are the missed opportunities, the ones that you could have seized but chose not to. Warren Buffett, for example, is known for saying that the errors he regrets the most are the ones where he didn't act, rather than the times he made a bad move. Let's break this down a little further. There are times when you might see a great opportunity, but don't take it because it feels too risky, or maybe you don't fully understand it. By not acting, you lose the chance to gain. This is the essence of the error of omission. Unlike errors of commission, which are visible and can be tracked, omissions are far more insidious because they don't show up on the balance sheet, yet they can have a massive impact on your overall returns. The danger here is that omissions compound over time. One missed opportunity might not seem like a big deal in the moment, but over the long term, those missed chances add up. If you've spent years avoiding certain investments simply because they were outside your circle of competence, you might find that you've missed out on significant gains. Sometimes, the fear of making a mistake keeps us from making any decisions at all, and that inaction can cost us more than we realize. Warren Buffett is often regarded as one of the greatest investors of all time, but even he has faced some of his biggest losses due to not acting within his circle of competence. The term circle of competence refers to the idea that you should only invest in what you truly understand. Buffett has repeatedly stated that his success stems from sticking to businesses and industries he is familiar with and avoiding the ones that fall outside his expertise. So when he ventured into areas he didn't fully grasp, even he faced the consequences. For instance, Buffett's foray into the airline industry is often cited as a mistake. Despite being an investor in countless companies, Buffett admitted that he didn't have a deep understanding of the intricacies of the airline business, including its cyclical nature and high costs. He entered the market with optimism, but ended up losing billions. This example shows the importance of sticking to what you know, as trying to operate outside your circle of competence can lead to avoidable mistakes. The key takeaway here is that knowing where your expertise lies can protect you from making major blunders. If you're unsure about a sector, it's better to pass on the opportunity than to chase after something you don't understand. Buffett's advice is simple: if you're going to make a decision, make sure it's something that aligns with your knowledge. By doing so, you'll reduce the risk of losing money and improve your chances of success. In investing, the biggest mistakes are often those that you don't make, not the ones you do. This concept might sound surprising, but it's one that Warren Buffett has emphasized time and time again. It's not just about picking the right stocks or timing the market perfectly. It's also about knowing when to do nothing. Many investors, especially beginners, focus so much on taking action that they overlook the power of inaction. This error of omission can be just as costly as making the wrong investment decision. Buffett's approach to this is simple. He believes in doing nothing if there's nothing worth doing. If a good investment opportunity doesn't present itself, he won't force it. While many investors panic and try to do something, even when the market is unstable or unappealing, Buffett sits tight, confident in his understanding that not acting is sometimes the best decision. This cautious approach is something many could learn from. So, when you're considering your next move, think about the opportunities you're passing up by not acting. Are you waiting for the right moment, or are you just feeling the pressure to be busy? Remember, sometimes the best thing you can do is wait, study the market, and act only when you're certain of your next step. By doing this, you avoid unnecessary risks and focus on what truly matters, making informed decisions. Warren Buffett is a legend in the investing world, but even he has made mistakes that cost him billions. The key takeaway, however, is not just about the losses, it's about what he learned from them. Buffett's misses are often the result of not acting when he should have, and this principle is a valuable lesson for all investors. If you think about it, losing money by doing nothing can be even more costly than losing money through poor decisions. The opportunity cost of missing out on a great investment can be staggering. Buffett's billion-dollar misses serve as a reminder that there are risks in both action and inaction. For example, there were times when he chose not to invest in technology companies early on, believing they were too speculative. While this decision was based on his circle of competence, it also shows that there are times when opportunities slip away because of hesitation. The lesson here isn't to rush into every opportunity, but to be aware of the long-term costs of not acting when you have the chance. When investing, learning from Buffett's misses can help you understand that timing is everything. If you're waiting for the perfect moment, you might miss out on something truly transformative. The key is knowing when to act, when to sit tight, and when to move on. By doing so, you can avoid costly mistakes and ensure you're always making the best decision possible for your financial future. Market timing is often considered one of the trickiest aspects of investing. Many investors believe they can predict exactly when the market will rise or fall, but in reality it's far more complicated. Even the most experienced investors, including Warren Buffett, have admitted that timing the market is a gamble. However, there's a big difference between trying to time every move and understanding the cycles of the market. Recognizing patterns and knowing when to enter or exit the market can make a significant difference in your returns. The best investors know that it's not just about timing the perfect moment to buy or sell, it's about understanding the market's behavior over time. They focus on the fundamentals and avoid getting caught up in short-term fluctuations. If you've done your homework and analyzed the market, you can make decisions based on logic, not emotions. By keeping a long-term perspective, you can weather market volatility and make decisions that will benefit you in the years to come. Investing based on timing alone is often a risky strategy. Instead, consider the value of timing in conjunction with your circle of competence. Invest in sectors and businesses you understand, and don't try to chase trends. By doing this, you reduce the risk of making emotional decisions during market swings and ensure you stay on track toward achieving your financial goals. Now that you understand the importance of the circle of competence, it's time to take action. Remember, the biggest investment mistakes don't come from making the wrong move, but from failing to act within your area of expertise. By focusing on what you know, you can avoid unnecessary risks and maximize your chances of success. If you want to be a smarter, more secure investor, this is the way forward. Think about this. Where do you have the greatest advantage? What sector or area do you know so well that you could confidently explore? By recognizing your strengths, you can unlock more profitable opportunities and protect your wealth from risky investments. The secret is to operate within your circle of competence. And remember, investing isn't just about making money. It's about learning from mistakes and improving with every decision. If you found this content helpful and want more tips to improve your investment strategies, subscribe to the channel and turn on notifications. You're ready to transform your investing approach and achieve the financial freedom you deserve.